Return on investment or yield. Which should you be using when evaluating a UK property investment? Hi, my name is Tony Law, and let's start this video off by very briefly looking at the yield equation because, let's be honest, that's the one that most estate agents will want to quote you when you inquire about a potential property investment. So yield is the annual rent divided by the purchase price multiplied by 100. Nice and simple. But let's take just a moment to look at this equation just a little bit deeper, and you'll see why in a minute. So with the annual rent, generally speaking, it's based on a single family unit renting the whole property. And in truth, there's not a huge amount that you can do to vary the amount of income that's coming in from a single family unit, is there? So let's look below the line at the purchase price. Well, purchase price is the purchase price. That's what you're buying it for. And so again, there's really nothing that you can do to change that figure, can you? Consequently, if you get 4 terraced houses in a row, and let's imagine that they're all pretty similar, they've all got 3 bedrooms, they've all got 2 reception rooms, well, generally speaking, they're all going to give you about the same level of yield, aren't they? And in this example, let's imagine that they're all giving a 5% yield. Now, property investors are people that are doing this professionally. They're kind of doing it every day, and they use a different set of calculations. They use return on investment. And so let's look at what that equation looks like. So this time, we start off by taking the annual profit, and we're going to divide that by the cash that we're investing in the deal. We multiply that by 100, and that gives us our return on investment. So again, let's just pause for a minute, and this one's really important, and have a look both above and below the line, and you'll see why it's important in just a moment. Let's start off with the annual profit. Well, what does that look like? Or rather, what's it made up of? It's made up of the annual rent that's coming in, taking away then the annual costs that are going out each year. And so with the annual rent that's coming in, is there actually anything specific that we can do to vary that? Well, the answer is absolutely yes, there is. You might choose to multi-let the property. You might use an LHA-based strategy. You might split that property up in some way to increase and boost the income. You might change it from commercial to residential or vice versa. In truth, there's a whole bunch of different things that you could do to change the level of income that's coming in. So what about the costs that are going out each month? Is there actually anything that we can do to change that? Absolutely. Yes, there is. You might have a mortgage with a sizable deposit, meaning that your monthly costs are going out mortgage-wise are less. You might have a very small deposit and a very large mortgage that's going to be taking payments out every month. You might have a number of different bills that you've got to factor into this. Frankly, the costs going out can vary enormously depending on what you're actually doing with the property. Let's now look below the line at the cash that we're going to be investing in the deal. Well, that's actually going to include the initial cash that you're going to invest, plus any refurbishment costs that you're going to be putting into this property. So with the initial cash that you're going to invest in this property, is there anything that's going to vary there or could vary there? Absolutely yes. You might decide to put 100% of your own funds into buying the property, or you might use an investor's money to fund this deal and in theory have none of your own money in the property. Obviously, that's going to change other parts of this equation, but it's a fact that can vary the outcome dramatically. Or maybe you're going to be somewhere in between. You might have a high mortgage, a low mortgage, etc., etc. So what about the refurbishment costs? Can they change? Of course they can. Depending on what you're actually doing with the property, they can vary wildly, especially if you're going to go and maybe change the class use or change the actual type of property. So all 4 parts to this can dramatically change depending on what you're doing with the place. And so if we take those same 4 properties, it's absolutely the case that you could get a 5% return on investment on the first one. You could get a 50% return on the property next door. You might get a 0 return on your investment on the third one. And if you've got none of your own money in the property deal at all, it's absolutely possible that the fourth one could give you an infinite return on your money. And if I look at my own spreadsheet with all my properties on it, in the right-hand column under return on investment. For some of the properties that I've got, it absolutely says infinite as the return on my investment. So the next time you're looking at the numbers, a number of different projects, and you're trying to decide which one you should go for, please ignore yield, can I suggest? And instead, take the extra effort that it's going to take to calculate a genuine return on investment. And then please base one of your decisions, or at least the main part of the decision, in my opinion, on that return on investment. I really hope you found this video helpful. If you did, please give it a big thumbs up, and because it really helps our channel. And please also subscribe. That way you won't miss out on any future videos that are going to be coming our way. And by the way, if you want to see 12 awful properties I think every property investor should be buying, click the link just here or in the description box below. Thanks so much for watching, and I look forward to seeing you in the next video.